Pros and cons of investing in cryptocurrencies. Almost everyone faces the issue of passive income or retirement savings at some point. Some people start saving a percentage of their income as a safety net, while others create bank savings accounts, and still others try to invest in real estate and live off the rental income. Unfortunately, the returns on such investments are low. Household savings and bank deposits barely cover inflation, and the real estate market appears to be overheated, making it a bad idea to buy now. In any case, doing something is better than doing nothing.
Risk is what keeps us young, isn't it, darling?
After all, there are investment techniques that may boost up deposits dozens of times over the course of a year or two. You are not mistaken. We're talking about investing in cryptocurrencies. You don't need a sophisticated understanding of finance or investment to make it a habit to set aside 10% of your monthly income and invest it in cryptocurrencies. If you do that on a regular basis, you can build up a solid investment portfolio over time. And that means you have a chance at a secure future and a comfortable retirement, not simply crumbs of a state pension. Of course, everyone has heard and knows that investing is a risky way to make money. And you take double or even triple risks while investing in high-risk assets, which include cryptocurrencies. Let's define what we mean by risks. The investment risk is the possibility of losing some or all of your savings. The list of reasons is long, but the most important factor is the asset's volatility or its tendency to quickly rise or depreciate swiftly. We're not talking about a specific asset, like the token of a new crypto startup, but about investing in cryptocurrencies in general. Because they have much higher volatility compared to other investment assets. It is because of those constant price fluctuations that crypto investments are considered high risk. If the chances of losing your investment are high, then who invests in cryptocurrencies and why? It's crucial to remember that risk and return are inextricably linked. The greater the danger, the greater the potential profit. This is the answer to the question of why investors choose to invest in cryptocurrencies. There is no other financial instrument on the market that can guarantee annual yields in the hundreds of percent. Take, for example, a few cryptocurrencies which have allowed many investors to profit handsomely from their investments. Let's begin with Bitcoin. In 2009, the price of Bitcoin was $0. The cryptocurrency never managed to hit the $1 threshold in the following year, 2010. The legendary purchase of 2 pizzas for 10,000 BTC, one BTC was worth $0.0025 at the time, occurred in 2010. The value of Bitcoin was fixed at $69,044.77 on the 10th of November 2021, 11 years later, up 43,300.4%. How do you like that dynamic? Consider the next cryptocurrency in CoinMarketCap's list, Ethereum, if you think this is an exception. Ethereum began trading at $0.43 in October 2015 and reached a high of $4,878.26 in November 2021, an increase of 428,081.7%. For example, the cryptocurrency Solana was worth $0.50 in May 2020 and reached an all-time high of $259.96 in November 2021, a price gain of 8,897.2%. Do you see the potential of cryptocurrencies now? Investing in cryptocurrencies, like any other investment, comes with a lot of dangers. It's one thing for investors to be warned about the potential outcome, to comprehend the dangers and to choose to invest in high-risk assets consciously. And it's another thing entirely when such decisions are made by newbies who have no experience with investing and have no understanding of how the business is structured and operates. To these, we may add the so-called investment lazybones, those who don't seek a deeper market understanding, don't research investment techniques, and buy impulsively in the hopes of getting the highest return in the shortest length of time. Here's a full examination of what happened in May 2022 with cryptocurrency Terra, to show what we mean when we say cryptocurrencies are high-risk assets. Terra is a blockchain platform that uses a delegated proof-of-stake consensus mechanism to issue algorithmic stablecoins like Terra USD, Terra KRW and Terra SDT. The project was launched by Terraform Labs in April 2019 on the Cosmos blockchain. The issued assets were pegged to their respective fiat currencies and backed by Terra's native cryptocurrency platform called Luna. The mechanism for issuing stablecoins was as follows. When stablecoins were issued, Luna coins were burned for the corresponding value, and when the stablecoins were withdrawn from circulation, they were exchanged for another asset via the same Luna. The stability of all exchanges and the fixed value of stablecoins was maintained by arbitrage. The process of making money from arbitrage through Luna in the Terra ecosystem was called seigniorage. The most common stablecoin in the Terra ecosystem is Terra USD, UST stock ticker symbol. Luna got herself into problems because of UST. More specifically, because of the peculiarities of the concept of algorithmic stablecoins, which the Terra project actively developed and propelled. This concept implied that the protocol relied on an algorithm to maintain the stability of asset pricing. 1 UST, for example, is equal to 1 USD. Luna tokens provide a balance that helps maintain the value of stablecoin through forced doping or burning. Users who desire stable Terra coin must burn a certain amount of Luna to match the asset price. A stablecoin must be exchanged for another asset in order to be removed from circulation. The transaction can also be aided by converting stable money into Luna management tokens. So, on the 8th of May 2022, UST plummeted to 0.99 USD, indicating that the stablecoin had lost its fixed peg to the dollar. At the same moment, the Luna token's value plummeted by more than 8%. The company told consumers that the asset value fall was related to the elimination of 150 million USTs from DeFi protocol Cofinance in preparation for deployment in the 4-pool liquidity pool. The business handed market makers $1.5 billion the next day to prevent panic and stabilize the UST's USD peg. The funds were sent in Bitcoin, BTC, and stablecoin UST cryptocurrencies. This did not help, as the ex-stablecoin UST reached a new bottom at 76.5 cents on the 10th of May. The Terra team held a community vote on the 11th May to raise the base pool from 50 million to 100 million SDRs. The vote was accepted by 325,760,000 users. The Terra community backed the team's idea with 67.08% favor. Unfortunately, neither of those steps worked, with the USD falling to 30 cents and the Luna price falling to 91 cents. Following this epic failure, Binance, a cryptocurrency exchange, declared on the 12th of May that trade of the Luna coin had been halted. The decision has been backed by a number of major crypto exchanges, and the exchanges Bybit, BitMEX and Fimex launched the process of delisting instruments on Luna. On the 13th of May, the project team decided to temporarily suspend the Terra blockchain. Luna had reached 7 trillion USD at the time of the closure, with a price of $0.402, despite the fact that it had achieved a peak of $119.18 just over a month prior, on the 5th of April. Also, the minimum USD exchange rate was also recorded at $0.0449 on the 13th of May. Despite the best effort of the Terra team, the USD stablecoin has never been able to restore its dollar peg. A collective price report has been filed against Terraform Labs CEO by Luna and USD investors. Following the collapse of the Terra ecosystem, the number of investors affected by the collapse of Luna and USD was so large that it sparked a public and political outcry. South Korean authorities demanded a parliamentary hearing to address the situation, and the G7 countries called for accelerated development and implementation of consistent regulation of cryptocurrencies. Unfortunately, such incidents are not uncommon, and the history of crypto industry is littered with them. However, this doesn't rule out the possibility of investing in cryptocurrencies. The blockchain industry is quite new, having only been around for a little more than a decade, and like with any young industry, there are still exciting things to come. According to CoinMarketCap, there are over 19,500 different cryptocurrencies now, and many of them can deliver their investors the coveted access, generously showering gains of 100, 300 or even 1,000%. The goal is to approach investing wisely, with information and a thorough understanding of investment tactics and ideas.